EPK Capital presents Deep Dive on IBM. Hello, and welcome back to the channel. I am your host, Rutvik. Today, we're tackling one of the most iconic names in technology, IBM. For decades, Big Blue was synonymous with computing. But in a world now dominated by names like NVIDIA, Amazon, and Microsoft, a critical question hangs over this 114-year-old giant. Is IBM a value trap, a relic of a bygone era? Or is it in the middle of a quiet, powerful transformation that the market is only just beginning to recognize? In this deep dive, we're going to cut through the noise. We'll analyze over a century of history, a decade of financial data, and the company's high-stakes bet on hybrid cloud and artificial intelligence. We'll run it through the ringer of a classic Benjamin Graham valuation, look at the stock chart, and weigh the powerful arguments from both the bulls and the bears. Our goal, as always, is to give you a comprehensive, neutral, and data-driven foundation to help you form your own informed opinion. So, let's get started. The company and its promoters, from tabulators to AI. To understand where IBM is today and where it might be going, it is essential to understand its long and storied past. The company's history is a multi-act play of dominance, near collapse, and strategic reinvention. The story of international business machines begins not with computers, but with clocks, scales, and punch cards. In 1911, financier Charles Flint orchestrated the merger of three companies: the Tabulating Machine Company, the International Time Recording Company, and the Computing Scale Company of America. The resulting entity was named the Computing Tabulating Recording Company, or CTR. The pivotal moment in the company's early history arrived in 1914, with the hiring of Thomas J. Watson Sr. as general manager. Watson, a man of considerable marketing skill and vision, transformed the company's culture and trajectory. He instilled a highly disciplined and professional sales force, fostered a culture of innovation, and famously adopted the simple, powerful motto, "Think." Under his leadership, CTR's revenue doubled in just 4 years, and in 1924, he renamed the company International Business Machines Corporation to reflect its growing global presence and ambition. While IBM was a dominant force in office machines and punch card tabulators for decades, its true ascent into a global technology superpower began in the 1950s under the leadership of Thomas Watson Jr. The younger Watson sponsored an all-out push into the nascent field of electronic data processing systems. IBM's enormous size, massive research and development budget, and established marketing expertise allowed it to quickly assume a commanding position in the American computer market. By the 1960s, IBM was producing an astonishing 70% of the world's computers and 80% of those used in the United States. Its specialty was the mainframe computer, expensive, large-scale systems that became the indispensable heart of governments, banks, and major corporations worldwide. For a generation, the name IBM was synonymous with the computer itself. The very dominance that defined IBM in the mainframe era became a liability by the 1980s and 1990s. The rise of the personal computer and the rapid acceleration of technological change caught the colossal company off guard. Its size hindered its ability to respond quickly, and it began to lose ground to smaller, more agile competitors. This period of struggle forced a fundamental and painful re-evaluation of the company's identity, leading to a series of strategic divestitures that reshaped the business. This was not a story of failure, but rather a calculated strategic retreat from commoditizing markets to focus on higher value segments. Key moves included the 1995 acquisition of Lotus Development Corporation, signaling a major push into software. The 2002 sale of its magnetic hard drive business, a technology it had invented in 1956, to Hitachi. The landmark 2005 sale of its iconic personal computer division to the Chinese manufacturer Lenovo Group. These decisions marked a deliberate shift away from manufacturing commodity hardware. The company was shedding its old skin to focus on computer services, software, supercomputing, and scientific research, areas where it believed it could command higher margins and build a more durable competitive advantage. The modern IBM is the culmination of this decades-long transformation. Under the leadership of Chairman and CEO Arvind Krishna, who took the helm in 2020, the company has sharpened its focus on two primary growth engines: hybrid cloud and artificial intelligence. The cornerstone of this strategy was the monumental $34 billion acquisition of Red Hat in 2019. This was not merely an addition to the portfolio, it was a defining move that positioned IBM at the center of the open-source software movement and made it a key player in the hybrid cloud ecosystem. The company's flagship AI platform, watsonx, is designed specifically for enterprise clients, emphasizing governance, reliability, and practical application over consumer-facing novelties. This is the new IBM, a software and consulting powerhouse built on a foundation of hybrid cloud and enterprise-grade AI. 10-year financial analysis, 2015-2024, a company's strategy is only as good as its financial results. To understand the tangible impact of IBM's transformation, we must analyze its performance over the past decade. The numbers tell a complex story of strategic contraction, volatile profitability, and a significant increase in debt. At first glance, IBM's revenue trend over the past 10 years appears concerning. Annual revenue declined from over $81.7 billion in 2015 to a low of approximately $55.2 billion in 2020. However, this decline must be viewed in the context of the company's strategic divestitures, most notably the spin-off of its managed infrastructure services business into the new company Kyndryl in late 2021. This move alone removed a significant amount of lower margin revenue from IBM's top line. Viewed through this lens, the period since 2021 becomes more telling. After the spin-off, revenue has stabilized and shown modest growth, increasing from $57.4 billion in 2021 to nearly $62.8 billion in 2024. This recent trend reflects the performance of the new IBM, focused on its strategic growth areas of software and consulting, which now account for a significant portion of the business. As of 2024, software represented approximately 45% of IBM's total revenue. The shift toward a software and consulting-led model is intended to improve the quality and consistency of IBM's earnings. The data shows a volatile but potentially improving picture. Operating margins, which were strong at over 20% in 2015, fell to a low of 3.92% in 2022 before rebounding sharply to 16.65% in 2023. The figure for 2024 settled at 11.97%. This volatility and profitability is also reflected in the company's net income, which has seen significant swings over the decade. The sharp recovery in margins in 2023 suggests that, as higher margin software becomes a larger part of the revenue mix, the company's overall profitability could improve. However, the subsequent drop in 2024 indicates that this transition is still in progress and has not yet achieved stability. Perhaps the most significant area of concern in IBM's financial profile is its balance sheet. The company's total debt load has been substantial throughout the decade, but it increased dramatically following the $34 billion acquisition of Red Hat. Total debt jumped from around $45.8 billion at the end of 2018 to over $68.1 billion by the end of 2019. As of the end of 2024, total debt stood at $58.39 billion. This has resulted in a very high debt-to-equity ratio, which was recently reported at 228.3%. A heavy debt burden presents several risks. It increases interest expenses, which can suppress net income. It also reduces financial flexibility, potentially limiting the company's ability to make future strategic acquisitions or invest aggressively in research and development without taking on more leverage. While some analyses note that the debt is well covered by the company's operating cash flow, its sheer size remains a critical risk factor and a central argument for those bearish on the stock's prospects. Benjamin Graham. Valuation. An intelligent investor, check. To provide a rigorous, fundamentals-based assessment, we can subject IBM to the timeless criteria laid out by Benjamin Graham, the father of value investing. His checklist for the defensive investor, detailed in his seminal book, The Intelligent Investor, is designed to identify financially sound, stable companies trading at reasonable prices. Let's see how IBM stacks up. 1. Adequate size. Graham required a company to have substantial annual sales to ensure it was not a small, speculative player. The inflation-adjusted threshold is now considered to be around $500 million in annual sales. With revenues of nearly $63 billion in 2024, IBM easily clears this hurdle. Result: pass. 2. Sufficiently strong financial condition. This is a critical two-part test of a company's balance sheet health. A. Current ratio. 2.0. This ratio, current assets, current liabilities, measures a company's ability to cover its short-term obligations. Graham wanted current assets to be at least twice current liabilities. For 2024, IBM's current assets were $34.48 billion, and its current liabilities were $33.14 billion, resulting in a current ratio of approximately 1.4. This is well below the required threshold. B. Long-term debt net current assets. This test ensures that long-term debt is not excessive relative to a company's working capital, net current assets, current liabilities. IBM's net current assets are approximately $1.34 billion, 3448B, 33 bars, 14B. Its long-term debt for 2024 was $49.88 billion. The company's long-term debt vastly exceeds its net current assets. Result: fail. 3. Earnings. Stability. Graham required a company to have some positive earnings for the common stock in each of the past 10 years. A review of IBM's annual earnings per share, EPS, from 2015 to 2024 shows positive earnings in every year. Result: pass. 4. Dividend record. The criterion calls for uninterrupted dividend payments for at least the past 20 years. IBM has a long and consistent history of paying dividends, stretching back many decades, easily satisfying this requirement. Result: pass. 5. Earnings growth. Graham sought a minimum increase of at least 1/3 or 33% in per-share earnings over the last 10 years, using 3-year averages at the beginning and end of the period to smooth out anomalies. The average EPS for the beginning period, 2013-2015, was $13.42. The average EPS for the ending period, 2022-2024, was $5.46. Instead of growing by 33%, IBM's average earnings per share have declined by approximately 59% over the last decade. Result: fail. 6. Moderate price to earnings, PE. Ratio. Graham stipulated that the current price should not be more than 15 times the average earnings of the past 3 years. As calculated above, the average EPS for the last 3 years, 2022-2024, is $5.46. Using a recent stock price of approximately $245, the PE ratio based on this average is 5.46, which equals 44.9. This is significantly higher than the 15x threshold. Result: fail. 7. Moderate price to book, PB ratio. Graham's final test required the price to book value ratio to be less than 1.5. He also offered a combined rule of thumb: the PE ratio multiplied by the PB ratio should not exceed 22.5. IBM's book value per share for 2024 was $29.53. The PB ratio is therefore 245 to 29.53, or 8.3, which is far above the 1.5 limit. The product of the PE and PB ratios is approximately 44.9 to 8.3, 372.7, which massively exceeds the 22.5 guideline. Result: fail. The results of this analysis are telling. IBM passes the criteria that reflect its legacy as a massive, stable, blue-chip company, size, earning stability, and a long dividend history. However, it fails every single test related to its current financial health and valuation. This suggests that while IBM was once the quintessential Graham-style defensive stock, the struggles and costs associated with its multi-year transformation have eroded the financial strength and margin of safety that Graham demanded. Pros versus cons, the bull and bear debate. The investment case for IBM is highly polarized. Bulls see a company on the cusp of a new era of growth, while bears see a legacy giant struggling to keep pace. Understanding both sides is crucial. 1. Entrenched position in hybrid cloud and enterprise AI. The core of the bull thesis is that IBM has carved out a valuable and defensible niche in the modern tech landscape. The strategy is not to compete directly with Amazon Web Services, AWS, or Microsoft Azure for public cloud supremacy. Instead, IBM is focused on the hybrid cloud market, a massive sector projected to grow at a compound annual growth rate, CAGR, of over 16%. Through its Red Hat acquisition, IBM provides the critical software layer, primarily Red Hat OpenShift, that allows large enterprises to manage applications and data seamlessly across their own private data centers and multiple public clouds. This is particularly appealing to clients in highly regulated industries like banking, healthcare, and government, creating a sticky, high-switching cost ecosystem. Similarly, its AI platform, watsonx, is tailored for enterprise needs, prioritizing governance, data privacy, and reliability over consumer-facing applications, a potentially lucrative subsector. Forrester has recognized IBM as a leader in AI governance and AI decisioning platforms. 2. A leader in the next frontier, quantum computing. While still in its early stages, quantum computing represents a potential paradigm shift in processing power. IBM is widely recognized as a global leader in this field, with a detailed 10-year roadmap and breakthroughs like its Condor chip featuring 1,121 superconducting qubits. For bulls, IBM's leadership in quantum computing is a significant long-term call option on a revolutionary technology that could unlock immense value in the coming decades, an asset they believe is not fully reflected in the current stock price. 3. Strong shareholder returns. For income-focused investors, IBM remains highly attractive. The company has a multi-decade track record of paying and increasing its dividend, making it a reliable source of income. With a current dividend yield of approximately 2.8%, it offers a significantly higher payout than many of its tech sector peers. This commitment to returning capital to shareholders provides a tangible return even as the market waits for the growth strategy to fully mature. 1. Intense competition and slow growth. The primary argument against IBM is the sheer scale and dominance of its competitors. In the broader cloud infrastructure market, IBM is a distant fourth player, with its market share in the low single digits, completely dwarfed by the big three: Amazon, 30% share, Microsoft, 20%, and Google, 13%. These hyperscalers are growing much faster and possess vastly greater financial resources to pour into research, development, and price competition. Bears argue that IBM has a history of being a pretender, not a contender, in major tech shifts, and that its projected mid-single-digit revenue growth is simply not compelling enough in a fast-moving industry. 2. Crushing debt load. As highlighted in the financial analysis, the company's balance sheet is a major vulnerability. The massive debt taken on to acquire Red Hat remains a significant overhang. Bears contend that this high leverage acts as a financial anchor, constraining IBM's ability to innovate, make further strategic acquisitions, or weather economic downturns as effectively as its better capitalized rivals. This financial risk could limit future growth and shareholder returns. 3. Erosion of legacy business. While IBM pivots to the future, a substantial portion of its revenue is still derived from its legacy businesses, such as mainframes and transaction processing. The bear case posits that the decline in these traditional revenue streams could accelerate outpacing the growth from newer areas like AI and hybrid cloud. If this happens, the company could face a prolonged period of stagnant or even declining overall revenue and earnings, trapping it in a cycle of running just to stand still. At its core, the debate over IBM's future boils down to a conflict between a niche strategy and the power of scale. The bull case rests on the belief that IBM's focused approach to hybrid cloud and enterprise AI for regulated industries can create a profitable and defensible moat. The bear case bets that the overwhelming scale, capital, and innovation speed of its larger competitors will ultimately erode that niche. Conclusion and disclaimer. After digging through the history, the financials, the charts, and the controversies, what is the final picture of IBM? On one hand, you have a historic tech giant that has successfully navigated a monumental, decade-long transformation. It has shed its low-margin past to focus on the future, hybrid cloud, and enterprise AI. It is a recognized leader in specific, high-value niches, generates strong cash flow, and rewards shareholders with a reliable, growing dividend. On the other hand, this is a company burdened by a massive pile of debt. It faces ferocious competition from some of the largest and fastest-growing companies on the planet. Its own growth is modest, its valuation by classic metrics is stretched, and it is dogged by serious questions about its corporate culture and legal practices. Ultimately, IBM is not a simple story. An investment here is a bet on Arvind Krishna's strategy. It is a bet that its niche leadership in hybrid cloud management and enterprise AI is a durable, competitive advantage that can withstand the onslaught from its larger rivals. This stock may appeal to a patient, income-oriented investor who believes in the long-term hybrid cloud thesis and is willing to accept modest growth in exchange for a steady dividend. It is for someone who sees value in its entrenched position with large, slow-to-change enterprise clients. Conversely, this stock is likely not for the growth-focused investor looking for the next NVIDIA. It is not for those who are unwilling to take on the risks associated with its high debt and the intense competitive landscape. And it is not for investors who place a high premium on pristine corporate governance. As always, this analysis is for educational and informational purposes only. It is not financial advice. Investing in individual stocks carries significant risk, and you should always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thank you for watching.